The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The AI trade is back. The question is, how do you value it? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. Definitely that's the question the market is asking. And I don't know if we have that answer yet, because take a look at where we set right here. The S&P is up 1%. Yes, the Nasdaq is up 2%. But if you take a look over the last 3 days, the S&P is still down 0.7%. Tech is still down 1.5%. Nvidia is still down 13%. So keep that in mind as we go through the close. I did want to point out, though, the Russell was less bad yesterday. That's now up by about 0.3%. And the VIX, though, Romaine, definitely calming down.
And it's interesting you put that in context, Alex, because the dip buying that we're seeing today on a certain level is, well, a bit cautious, if you will, here. It's being carried out with the tinge of caution here on this afternoon, particularly given that we are scheduled to get a slew of earnings out of tech companies over the next 24 hours or so that could actually change the narrative on AI once again. European chip giant ASML is scheduled to report overnight Tuesday. And then, of course, we get IBM, Microsoft, Tesla on Wednesday, Intel and Apple bookending things on Thursday. A lot to keep up with here, with barely a fifth of the S&P quarterly earnings out. And that index right now is on track to post an EPS gain of 8.3% year over year. That's with or without the help of big tech, and that's better than preseason expectations. Now, the initial boost came from financials a couple weeks ago, and today the upside is presented to you by cruise line Royal Caribbean, by landing gear maker Crane, and believe it or not, by glimmers of hope over at Boeing. Now, that's just enough to compensate today for some of the negativity that we're seeing swirling around airlines, automakers, and defense stocks. GM, JetBlue, Lockheed, all disappointing with some of their earnings commentary today. And as investors digest earnings, they're still, yes, Alex, they're still going to have to digest whatever Jay Powell decides to spoon feed them tomorrow. The FOMC's two-day policy meeting underway. Swaps show traders expect a pause in interest rate cuts, but they aren't sure how long it will last. And that's where Powell's tone at his press conference comes into play tomorrow. I hope to see you there.
The Fed? What? No, we got earnings from Meta tomorrow. The Fed, huh? Okay, well, here's the earnings outlook, right? The idea is, will we see Magnificent Seven earnings come down and the rest of the S&P go up? Now, this chart comes from Capital Economics, and they see something, Oxford Economics, and they see something very similar. So you take a look at this magenta line. It's Mag 7 looking to grow, let's call it 18% for 2025. But you're looking at the blue line, which is the S&P X Magnificent 7, and you're looking at 13, let's call it, percent growth. And you can see over the last couple quarters that gap has been narrowing. And if we wind up seeing consistent moves to the upside with the other tech stocks, maybe that becomes that breadth we've been looking for. Oxford Economics sees that will happen because of manufacturing and that consumer spending, Romaine.
And you're already starting to see that play out so far this earnings season. Lori Heinel joins us right now to kick us off to the close on this Tuesday afternoon. Already feels like Friday, given how long of a day we had yesterday. Global Chief Investment Officer over at State Street Global Advisors. And Lori, let's start off with the sell-off yesterday, and I guess the little mini rebound that we're getting today. I know we haven't clawed back all of those gains, but when you sort of take the temperature of market sentiment and whatever rattled them yesterday, has that been settled?
I don't think it's been settled at all. In fact, we've been writing for quite some time now about stretched valuations in some of these companies, the fact that there are other threats out there. You think about, antitrust, you think about regulatory, you think about tax policies. There are a number of things that could still impact some of these high flyers. And against a backdrop where they're so fully priced, it's not surprising to see a bit of a wobble when you have something come to pass like yesterday. The other side of it, though, is that we do think that these are technologies that are durable and enduring, and ultimately it's going to be the beneficiaries, the financial companies, the consumer goods companies, those companies that are going to deploy these technologies to great effect.
So when you look at some of the buying that we're seeing today, let's just kind of extrapolate this into the earnings season, because we are going to start to hear from some of these companies that got sold off yesterday. Are you confident heading into this earnings season, even irrespective of what we learned out of DeepSeek yesterday? Are you confident in this earnings season that those big cap names will deliver on expectations?
Well, they're likely to deliver on expectations because a lot of that is already baked, if you will. Like it didn't just change yesterday. Like this is, fourth quarter of 2024 they'll be talking about. But it'll be very interesting to see what they talk about going forward. There's an enormous amount of capital investment in these companies. There's an enormous amount of demand for their products. There are lots of knock-on effects, including energy utilization. So it'll be interesting to see how they talk about the potential threat that this kind of, evolution creates for them. So that's what we'll be looking at more than just the earnings themselves.
Lori, the question is breadth continuing to expand? Do you see that continuing?
We do, and this is something that we really highlighted in our 2025 outlook, is that it didn't take the Mag 7 continuing to have these double-digit gains to propel the market higher, and that a broadening out as we see sort of stable growth globally was what we were looking for more, and we are seeing that. We're seeing financials, we're seeing consumer goods, we're seeing even healthcare. Many of those parts of the market that just have not been loved are now starting to get a little bit of a bid.
So, Lori, does that mean that you rotate, say, out of big tech into different sectors? Or is it just reallocating capital, say, from cash or money market funds into those other names?
It's a little bit of both, honestly. So some of it is, rather than just sort of have the concentration risk of the S&P 500, can you look at something that's a little bit more equally balanced and participate in that market broadening out and the fact that other legs of the market are likely to propel us higher? But it's also looking opportunistically at where to deploy cash. Now, as long as rates still remain in that sort of 4% plus range, cash is still relatively attractive. But if we do believe in this kind of global growth story, this is a good opportunity to enter in some of these unloved sectors.
I'm glad you mentioned rates. Alex doesn't want to talk about rates, but I'm told the Fed still matters, Lori. And I am curious, in all seriousness, even looking past Wednesday's Fed decision and looking ahead to some of the inflation data that we get on Friday, the expectation, at least among economists, we are going to see an increase in personal spending, personal consumption, and potentially a slight increase in that key inflation number. Should markets be a little bit more worried about that? Or are we kind of in, I guess, enough of a sweet spot where they can continue doing what they're doing?
Well, I think the first thing is that we're likely to see the Fed stay on hold, and it'll be very interesting to see how they describe that, because one narrative is that they've already done enough work. They want to see how that passes through to the real economy. We are seeing kind of core measures flattening out, so that's really good. And we don't see any imminent threats to a spike in inflation on the horizon, so that'll all be good. But the other side of this is what are the risks that they talk about? And one of the things that they've been quite vocal about is that there are a lot of policy-related things that are coming out of the administration that could potentially be inflationary. So it'll be more how they pose that narrative of what the pause means and what they'll be looking at going forward that we'll be watching.
All right, Lori, always wonderful to talk to you. Lori Heinel, a great kickoff here to the close, Global Chief Investment Officer over at State Street Global Advisors. Coming up here on the program, tech stocks really trying to shake off the DeepSeek shock. A conversation about what DeepSeek really did with artificial intelligence pioneer Andrew Ng and the future of America's AI dominance.
Plus, Xerox stock under pressure today after releasing earnings. CEO Steve Bandrowczak joins to talk about how the company plans to make sure 2025 isn't a copy of 2024.
And remember Brian Niccol? He did a great job at Chipotle. How's he doing over at Starbucks? The relatively new CEO scheduled to report earnings after the bell. We're going to set you up for what to watch there. Stick around. A lot coming up here on The Close. This is Bloomberg.
AI stocks recovering today after the threat of AI startup DeepSeek sparked a major tech sell-off yesterday. So I wanted to get more insight on this with Akeem Azhar. He is the founder of Exponential View, a digital fellow at Stanford University and executive fellow at Harvard Business School. Akeem regularly advises global politicians, business leaders on the challenges and opportunities presented by AI. The perfect person to talk to, Akeem. So based on this, you've been aware of DeepSeek for a while, right? Mm-hmm. How do you rate it?
Well, I quite like it, to be honest. As a user, I have started to use DeepSeek, this reasoning model that everyone got excited about a few days ago, and the previous version. And I find it's about a quarter of my AI use. It's a very nice, fast product, and it also happens to be free. So I think they've done something quite clever here.
Is it accurate?
It's pretty good. I mean, it is pretty good. How accurate are these AI systems ever? They're getting much more accurate. And there are certain things, of course, that DeepSeek, being a model that's built in China, won't talk about. But those aren't the kinds of things that most of us are asking about on a day-to-day basis.
Well, I am curious, though. I mean, from an investor perspective, one of the big questions that I think everyone wants to know is, how did they do this at the purported cost that they did it? I mean, this is sort of the parlor game going on as we head into an earnings season where we're going to hear Microsoft and Meta and all these companies talk about this CapEx spend, which is in the tens of not hundreds of billions of dollars. Meanwhile, you have this company over there in China seemingly able to do this for millions.
Absolutely. I mean, I think $290 billion or $300 billion earmarked for this year from the big four CapEx hyperscalers, which is pretty tremendous amount of money. And I think the answer is that necessity is the mother of invention. And as a result of the first tranche of export controls from the Biden administration, it's been harder and harder for Chinese firms to get access to high-end chips. The venture capital market in China is pretty moribund as a result of some policy decisions taken in the last couple of years. So the staggering funding rounds that we hear OpenAI and their competitor Anthropic get in the US don't happen in China because the venture capital market isn't as deep. And China's mega tech firms, Alibaba and Baidu, Tencent, are much smaller than the American firms. So without as much capital to go around and without access to the highest end chips, you're really forced to be incredibly efficient, incredibly innovative, and very, very inventive. And I think that's what we have seen here.
Yeah, absolutely. And that seems to be the narrative unfolding. I do wonder, Azeem, in your opinion, does that change the course for some of the big U.S. companies? Meaning, can they, I guess, find a way to be kind of that startup, that nimble, scrappy competitor that a lot of them once were, 20 years ago during the internet and e-commerce boom?
Well, Roman, I'm sure that there are some very, very uncomfortable conversations being had around the west coast of the US, and there are some engineers, no doubt, who've had some very difficult moments in the last few days. But the thing about the bosses of these big firms is that they know better than anyone else that technology always gets cheaper. That's what it does. And if you work in tech, in computing, in the internet, what you've seen over the last 30 to 50 years is that constant decline in the cost of the underlying technology. And these executives will also know that it's not just the hardware, Moore's law, that is the clock speed of the tech industry. It's also the optimizations you can make in software. And software optimizations are actually often much, much bigger in magnitude than hardware ones. So I believe these executives would have known, would have expected there to be significant cost declines and efficiencies. The first time you build a frontier AI model, you don't care about efficiency, you care about performance. You've got time in the months after and the quarters after to improve it. I think what is surprising is the timing. I suspect that people are a little bit shocked, as I think many of us were, that DeepSeek was able to come out an order of magnitude cheaper at the end of 2024, which they did. And I think that's where the surprise has come.
But on that point, though, I mean, first of all, at least this is supposed to be open source. So I assume it wouldn't be too hard to kind of reverse engineer what they do. I mean, I couldn't do it, but I'm sure somebody smarter than me could. But it raises a question as to why we didn't see a bit more collaboration amongst companies. And I know you kind of hit on it partly with the export controls on chips, but it seems like all of this could have been resolved had we seen more cooperation, not only just among companies, but among nation states themselves.
Cooperation, I think, is really important for pushing technologies forward. But sometimes that cooperation happens in the way that DeepSeek has done it, which is they have published a reasonably detailed technical paper. They have exported the model as open weights, which means anyone can go off and run it safely on their own computers, as I am doing. And that allows other engineers to look at what's been done and try to figure out how they can apply that learning into what they do. I think the deeper question is, to what extent will the very large American firms now start to say, yes, we have this advantage at scale, but we also now need to put a little bit more effort in being more efficient more quickly?
So, Azeem, to that point, to me, then the Microsofts and the Googles and the Metas, this should be good for them because maybe they can wind up building all this stuff for cheaper. Yet that wasn't the takeaway yesterday. So where am I wrong in that?
Well, I think the market had to respond very, very quickly. We can trust in the market over the long term, but I think in the short term, sometimes, the animal spirits get the better of it. I think it is better for the Googles and Metas and Microsofts because it's going to reduce the cost of delivery. I think it's particularly good for Apple because Apple has been seen as an AI laggard. And also, Apple is the firm that has this very distributed infrastructure, which is our devices and our laptops, which are quite small and they need portable, efficient models. And I think DeepSeek has shown the way. So my own reading is that this is generally good for most of the big companies. It's particularly good for Apple because it provides them a route in, and it will accelerate the development and deployment of AI systems across the US and global economy.
All right, Akeem, great stuff. Akeem Azhar, of course, one of the big thinkers in the tech space, the founder of Exponential View, and he was talking about Apple. I was just taking a look. Apple right now having its best two-day run going back to June. Remember, this was kind of the forgotten stock. I think people were just kind of concerned. They didn't have an AI plan, concerned iPhone shipments weren't what they used to be. But the setup heading into their earnings tomorrow, Thursday?
Yeah,
looking pretty good.
Well, also, though, they hit that key technical level, too, so bouncing off of that also makes sense, but it was up yesterday in comparison to the rest of the Mag 7.
Yeah, no, most of the Mag 7 now in the green, all of them in the green now, led, of course, by who else? NVIDIA, up about 7-8% right now, heading into the close. When we come back, we're going to take a closer look at LVMH. The ADRs here in the U.S. down about 3 to 4%. A pretty bullish commentary out of the CEO, Bernard Arnault, but when you look at their earnings, well, investors didn't quite take it that way. We're going to get some insights out of one of the key analysts in the luxury space. That's coming up next here on The Close on Bloomberg. All right, let's get right to the big movers on the back of analyst recommendations, top calls. We start with Astera Labs, the AI darling that had quadrupled in price since its March IPO, getting an upgrade today to outperform. This at Northland Securities following that 28% DeepSeek-related plunge. Northland says that the stock is now, that plunge has opened up an attractive entry point, saying that while demand for AI training may diminish, that should be offset by increased demand for AI inference, a key distinction. Shares up 7%. Next up, Autodesk, the architecture design software company, upgraded to outperform at Mizuho. The price target getting a big bump from a near street low $280 a share to a now street high $400. The analyst citing his channel checks as well as improving macro trends and says the rollout of that new transaction model should be a tailwind for revenue, free cash flow, and margin expansion. Those shares up 4%. And finally, Victoria's Secret. Take a look at this. Barclays analyst Adrian Yee returning to an overweight rating on the stock for the first time in 2 years, saying the lingerie retailer fits her criteria for a turnaround story. Positive comp sales, promotion growth for its namesake and Pink brands, and a positive direction in leadership with a new CEO that's pushing the shares higher. And those are some of our top calls. We do want to stay in the retail space and turn to the luxury labels. LVMH, responsible for high-end brands like Christian Dior, Givenchy, out with rather subdued earnings this afternoon. Sales overall down about 1% in the quarter, though the CEO, Bernard Arnault, given a relatively bullish commentary to analysts and investors earlier today. Swetha Ramachandran joining us right now, co-manager of Global Select Strategies at Artemis Investment Management. And Swetha, let's start off first with the numbers themselves. They were down. We expected them to be down. Why?
So the key fashion and leather goods segment at LVMH, which is really the main share price driver and the main profit driver of the group, that is experiencing a cyclical slowdown along with the rest of the luxury sector, but it is sequentially improving. So having troughed at minus 5% in Q3, it was down minus 1% in Q4. However, that was not enough given that peers such as Richemont have reported jewelry sales, which is their flagship business, up 14% for the same calendar period. Burberry, Zegna, all flagging a sequential improvement. So I think this was seen as a little bit of lacking in that the magnitude of that improvement was not sufficient relative to what the market was expecting.
So Swetha, do you think that's legit or is this an overreaction?
Well, I think certainly in terms of the top, there's one aspect is the top line, which although is sequentially improving, is not back in positive territory for that key segment. The second is the extent of operational deleverage. So margins for the full year, EBIT margins were down about 340 basis points, down nearly 500 basis points for the second half of the year. And that, I think, is different from what the rest of the peers have reported, who have only reported top line updates, not yet the full P&L. So it's somewhat indicative of perhaps what the cost of doing business in the last year has been. The fact that price increases have been really nearly impossible to take, given the consumer has been flailing, that all suggests that profitability, the margin picture, has remained under pressure.
Of course, we know LVMH, of course, for all of its luxury apparel brands, but I am curious about the wine and spirits segment. I mean, that was down 8% on a year-over-year basis. That was way worse than what the street was looking for. I think they were looking for a drop of about 7% here. Is there any sort of hope that that could be turned around? Because that's a totally different story than what's going on with purses, handbags, and everything else.
Indeed. I mean, they're fundamentally exposed to cognac in the US, which remains very weak. And actually on the call, they suggested it could take up to 2 years for that to actually improve from here, which does have negative read across for peers such as Remy Cointreau as well. And so I think that paints a pretty bleak picture, as well as the fact that champagne, which is their other key business, did not experience that same seasonal celebratory effect it did at the end of last year as it usually does. And the other impact has also been that they have categorically ruled out any divestment of that wines and spirits business, which they part own with Diageo. And so they're committed to continuing to own it, even though it remains a drag on group top line as well as profitability.
Swetha, before we let you go, what is your top pick in retail, right, in the luxury retail space, and what's going to be that catalyst for that stock?
So, I mean, I guess this is uncontroversial, given it's done quite well already in a sense. Richemont, I think the gap that's really opened up here, which is that in the third quarter of the year, the gap between Richemont and LVMH's top line was 9 percentage points. When you come to calendar Q4, that gap is 15 percentage points. So I think there's something deeper going on here, which is that jewelry category fundamentally is enjoying different dynamics. The top line tailwind is there, and the business, the brands Cartier and Van Cleef are also executing in a much superior fashion to most of soft luxury at this time.
Before we let you go, is it going to be China that's leading it or the U.S. now?
I think all eyes are on the U.S. Mr. Arnault commented on the fact that he expects a boom in that market. He was quite prominently placed at the inauguration last week. And there are a lot of expectations that sequential improvement we saw in the U.S. consumer continues into 2025.
All right, Swetha, always good to see you. Thank you so much for joining us. Swetha Ramachandran of Artemis Investment Management. And timely, too, because actually it's our 1-year anniversary almost.
Is it?
So I'm assuming
I didn't get you anything.
That the jewelry will be coming from Tiffany's, right?
Yeah, well, maybe. We'll see. I was just going to get you like one of those like little lollipop rings, remember, when you were a kid?
Those, though.
I know. I used to love those.
Pretty easy to please, actually, surprisingly, as you would not think. All right, just taking a look at Boeing, for example, really erasing any earlier gains, which is quite interesting. Had a gain about 7% and now we're erasing that. Yeah, I thought we had a glimmer of hope there. I mean, well, we'll see, Alex. Yeah, definitely, apparently not. All right, coming up next, we're going to speak to Chad Tredway, head of Real Estate Americas over at JPMorgan Asset Management, where he's finding opportunity within that real estate sector and how you diversify into that this year if rates kind of stay where they are from the Fed. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So the equity market pairing some of those losses from yesterday, but Romaine, we're still down overall over the last 3 days. We can't forget that, particularly when it comes to tech. Yeah, it was a major course correction, at least in sentiment, if not necessarily on technical levels. But the fact that you did see the dip buyers come in, and they came in a little late. It wasn't necessarily right out at the gate at 9:30. But as the day went on, you saw a lot of people looking at valuations and thinking, okay, look, is NVIDIA really going to go away? Is Microsoft really going to go away? And you're seeing buying around the edges. Yep, and the comparison of how it's not like 2000, for example. Well, JPMorgan Asset Management is out with a new report that's highlighting real estate as a sector to watch in 2025, writing U.S. real estate presents a generational investment opportunity as valuations appear to be bottoming out with improving fundamentals. Joining us now to discuss that is Chad Tredway, head of Real Estate Americas at JPMorgan Asset Management. All right, Chad, walk us through why right now real estate's going to do it for me.
So I was here about a month ago. I'm saying it again. Real estate is a generational opportunity because real estate just doesn't go on sale that often. The last time we saw values depressed to this level was over 15 years ago. If you invested coming out of the Great Recession, you made 4 to 5 times your money in the appreciation cycle. We're seeing flows across our platform. I was here about a month and a half ago. We've seen $1 billion of flows come into our funds, which shows investors are excited.
But aren't things sort of cheap for a reason, right? There's the whole return to office and the questions about office space. Now we have questions about data centers when it comes to AI.
I'd say, look, even office is coming back and real estate is cyclical. Just to give you a sense of this, before I came over, I tried to make a reservation for a business dinner in New York, couldn't do it until March. The other thing we see is if you go on LinkedIn, job postings for remote work topped out at 20% of overall postings in 2022. Today it's 8%. So return to office is back, New York is vibrant, and we're gonna see holders of high quality office, the best office around the country, see gains.
This is actually a good kind of setup because a little bit later we're going to talk with the CEO of Partners Group, and they've kind of been dabbling in this. But the whole conversation is about that proverbial dry powder, the cash on the sidelines, and the idea that people are looking for a home for it. And I know that a lot of big investors are looking to real estate. But where in real estate? It's not just Class A offices or multifamily, or is it?
Housing's a big theme.
Yeah.
We all know that we're 5 million housing units short for Americans in the United States, specifically in places like the Sun Belt where we see migration trends. We also wonder where people go on Friday afternoons. Typically, they're going to strip centers. They're getting their nails done, they're getting their hairs done.
While they're watching Bloomberg Television, the close.
While they're watching Bloomberg, the close, exactly right. But what's exciting is people want to spend money on experiences. So that's a big theme. And last is logistics real estate. People want their goods faster. So when you order on that phone, you want packages at your doorstep, and our investors love that we're invested in those segments.
I know. I ordered something on last Thursday, and it still hasn't arrived, and I'm like up in arms. I don't know what's going on. But in all seriousness, though, too, I think the last time we had you on, we also asked you about data centers and all of the interest in that. As you might have heard, there was some news came out yesterday that seemed to sort of, at least, if not alter people's expectations about the AI trade and the data centers and the power that goes into all that. It certainly caused them to at least step back and take a closer look at it.
Data centers have been all over the headlines, but what you're seeing now is the pace of technological change. It's incredibly difficult. So a data center could be over $1 billion, but 2/3 of that cost is the power that's supplied to the data center and the infrastructure. So at our firm, what we look at is real estate, and we're able to buy real estate below replacement cost today, which is very exciting. We don't bet on technological changes in data centers.
So you don't have any exposure to that sort of build out?
In our fund, it's pure play real estate.
Okay. What is the allocation that you suggest that people have towards real estate in a portfolio?
So we love it. We see it in a tradition.
We know you love it, but what about my portfolio?
We think it's great because it's not correlated to stocks or bonds. So typically we see people introduce real estate to 10 to 20% in their portfolio in a regular 60-40 portfolio. It gives them appreciation, it gives them inflation protection, and it's a natural hedge for inflation.
I am curious. There's a lot going on in Washington, particularly when it comes to tariffs. And you mentioned logistics and things like that. Obviously, retailers, e-commerce companies are going to be affected if tariffs do materially increase or expand much broader here. Does that affect the real estate proposition for warehouses and logistics centers, et cetera?
I think it only strengthens it. So when you think about tariffs, think about supply chain efficiency, onshoring, getting goods to consumers faster. Things like industrial outdoor storage, infill warehouses, truck terminals, all these things help goods move around the United States to your doorstep to get that package you ordered a few weeks ago.
You're very optimistic, by the way.
He's very excited.
Is this like, and also, and I'm not trying to be glib about it, but is this like the best opportunity you've had in your career in real estate?
I would tell you we could be entering a super cycle for real estate, just given the current policy, the facts that rates will come down at some point, and the demand drivers that we see in the economy.
Well, let's end on that, because when you say rates coming down, like they're not coming down as much as we thought 6 months ago. 6 months ago, it was all about like rates are going to come down hard. This is going to be the moment. We're going to finally get out of the water when it comes to real estate that was underwater. But we don't have that anymore. So how does that make sense?
I would tell you, even if rates don't come down, the demand for real estate right now, specifically in logistics, industrial, and housing, is so strong that the cash flow gains over time will be a boon to the sector. If rates come down, it's just an added benefit for us.
All right, so you don't really care what Jay Powell says tomorrow then?
We always care about rates in real estate, but we know rates will come down. Yeah. How fast or how soon, we don't know.
All right, Chad, always a great conversation. Chad Tredway, he's the head of Real Estate Americas at JPMorgan Asset Management, seen a lot of opportunities out there and a lot of money flowing into the space. We want to switch gears from real estate to Xerox, the consumer electronic company, out with earnings, a miss on adjusted fourth quarter earnings, but the CEO optimistic on the year ahead, saying that in 2025, we expect to build on changes made last year in order to focus on executing our reinvention strategy. I'm pleased to say joining us here in Studio 2 is the CEO of Xerox, Steve Bandrowczak. Steve, great to have you.
Welcome. Thank you for having me.
What is the reinvention?
Yeah, the reinvention is about getting Xerox back to being a tech powerhouse and driving productivity in the workplace. You just talked about real estate a few minutes ago and what's happening with inside the workplace. People are working all over the place in different areas, and we've always been driving that productivity in the workplace. So part of the reinvention strategy is three things. One, how do we get back to a declining core business that's declining single digits? How do we get back to growth? What do we do there in growth? And there are sectors that are actually growing. We have A4 printers, color, they're actually growing. We grew double digits in Q4. We have the ability to be able to outgrow the market and market share through changing our channel partners, productivity in our sales force, and so forth. So how do we get our core strengthened so that decline is slowed down? Second piece of it is how do we get 20% of our revenue in growth areas? So we just acquired a company called IT Savvy, which is around IT solutions. And if you think about what's happening in the workplace today, technology is complex. AI is complex. All the different major trends in technology is tough. They're looking for a partner like Xerox who can bring solutions. We're going to be a solutions-driven, a service-driven, software-enabled business going forward. And we can help our clients, especially in the mid-market, drive and help them inside of driving productivity and IT solutions. So you think about some of the big tech transformations, Windows, AI, et cetera.
I'm very fascinated by this. And in full disclosure, I actually started my career covering Xerox. I won't tell you what year that was, but it was a much different company then. It was going through a lot of issues. When I look at the breakdown, what you sell in equipment and the idea of kind of post-sales revenue, which is now the bulk, or it's always been the bulk, but it's become much more dominant. What is the complexion of that? Who are you selling to? What types of sectors? What types of companies?
Yeah, so two different worlds. One is we have our major direct sales where we sell a lot into SMB, right? So a lot of the small businesses, medium business, over 200,000 plus accounts. Large channels where we sell into, and we have channel resellers that sell over 10,000 channel partners that sell around the world. So we sell into EMEA. In the EMEA, we got about 45% of our business there, and then the 50+% in the Americas. So medium SMB business. But more importantly, we're now creating vertical solutions. So you think about how you can sell into hospitality, how you can sell into education, and how do we put infrastructure around our devices that drives productivity in education. So we talk about AI, there's a lot of AI today. You think about the printer has a lot of intelligence and a lot of capabilities in there that we can help with document flows, we can help with intelligence on documents and driving productivity in that space.
To be honest, the street doesn't like it right now. I mean, the stock is off over 6% off its lows, but still short interest was also building into the quarter. What do you think is being missed right now?
I think the reinvention story in terms of where we're going, right? They're looking for us to give proof points on the IT solutions.
So it's the acceleration part of the story that you guys are hoping to execute this year and next year. You feel like that part's being missed?
That's correct, right? And it's a timing issue, right? We're doing a lot of different things, and it's very difficult to do the amount of change that we have as a public company and doing all the changes that we're doing simultaneously. That's the part that they're missing in terms of where we're going, right? We acquired IT Savvy, we acquired Lexmark recently, and so the story is going forward, we will get to growth, we'll get to double-digit operating profit.
When do you think you see it's not a trough really, but when do you think you start to see the turn where investors and analysts can really start to see that momentum?
We're seeing it internally, right? In terms of the key performance indicators that we see, whether it's around orders, whether it's around growth, whether it's around mix in our revenue, we're seeing it. As we get into end of second quarter this year, we'll see Q1 growth year over year, we'll see Q2 growth year over year, and they'll start to see it as we get out to the second half of the year.
I want to ask you about the structure of the company itself in terms of the amount of employees you have. Are they all working from the office? Do you have more of a remote strategy, hybrid remote strategy? What's that been like coming out of the pandemic?
More hybrid, all over the place. Now I've got 10,000 service technicians that work in the field. So by its very nature, we got people in trucks, we got people touching clients all around the world. And then the rest of it is a hybrid strategy where we've got people that are working from home that have certain expertise. And then we've got individuals that are working in the office.
Are you hiring a lot right now?
We're not hiring because right now we're integrating companies and you want to make sure that we get the best of the acquisitions that we've made. And as we're going through that, we will look for technical skills, specifically in software and software engineering.
When you take a look broadly, because you guys are a global business, talk to me about the impact of the stronger dollar and sort of headline risk when it comes to tariffs. Like, how do you guys think about these macro problems?
I think for us, everybody in the tech industry is dealing with tariffs today and is dealing with these macro trends. And so we will adjust to them. Our supply chain is flexible. We'll adjust to whatever tariffs come our way. And we've always done that historically. During the pandemic, we saw supply chain challenges. It's the same thing for us on the tariffs. Everybody in the tech industry is dealing with it.
Strong dollar freak you out or no?
No, doesn't bother me at all.
Why not?
Well, look, we got diversified business, right? So I've got businesses in Europe, businesses here in the U.S. So we got a diversified business and it's balanced. So strong dollar doesn't bother me at all.
There are, of course, a lot of, I'd say, institutional investors. They look at your market valuation and they say this is a company, and they look at your assets and they look at a company that could be ripe for an acquisition itself. Have you been approached at all by any other companies?
So we have always said, and I've been very bold, we want to be in the position to be the acquirer and the consolidator of our industry. If you think about our industry today, we've got many Japan players in our industry. We think that there's ripe for consolidation. I did the IBM PC spin out many years ago, was part of the team that built Lenovo. And at that time, we got the same dynamics in the print industry. It needs to consolidate. We will be the consolidator.
Is the business environment conducive to those types of acquisitions, particularly? You mentioned Japan. Do we get a cross-border transaction like that done these days?
Well, look, it's always difficult in that environment in Japan with Japanese players for sure, but there are a lot of other roll-ups that we can do, specifically in our industry. So we will be the consolidator.
Yeah, and you're still integrating, of course, the IT savvy as well as I'm saying Linux. Lexmark. There you go. Okay, so there's a lot to be done on that front. Talk to me a little bit about how you see your cost cutting and your margins versus your growth. Like, you guys have been in cost cutting mode, particularly with the synergies you're going to get from these acquisitions, and that's going to help margins. But at some point, it's going to be that top line.
Yeah, look, growth is important for us, and part of the reinvention is getting back to growth. So I talked about acquiring IT savvy. You think about that space alone, the CAGR over the next 5 years has got mid-single to high single-digit growth just in that space with the tech transitions that we see. So the idea is to get 20% of our revenue that is in high growth areas. Digital services, we talk about AI, you spend a lot of time about AI, but think about your cell phone without a network connection. AI without data is completely useless, right? And so we play a role in aggregating data and serving data up for all these AI modules. When you think about AI, it's about the workplace in terms of the process and adding AI on top of the process that actually drives value. And that's what we play. We've got tremendous amount of intelligence in industries like education in law firms. You see it in hospitality, you see it in education. And so what we do is we bring a tremendous amount of intelligence, serve up that data, and then when you put AI on top of it, it actually has real use cases that drive value.
So do you sell that data to like large language model firms to then model? Or
we don't sell it.
You use it yourself?
We don't sell it, but we help our clients. We want to help our clients be successful.
Hence a service.
As a service, exactly. So you think about, when everybody thinks about data, everybody thinks about static data, whether it's, CRM data, whether it's around financial data. But think about video. Think about sensor data. Think about data in motion. How do you aggregate all that and you make it such that you have really real-time actionable solutions? Video, for example, on education campuses. Well, that video is only as good as the AI, and then that AI has to be able to turn it into some sort of action. And that's where we play because we're really good in that space.
We only have time for one final question. And unfortunately, it's a bit of a complicated question, and it is about efforts at maintaining diversity. Xerox was a pioneer in that. You go back to Bernard Kinsey and what he did back in the 70s, and I've had family members who found their way up through, the old school companies here in the Northeast. does that exist anymore? Is there still a commitment to that?
Oh, for sure. We're extremely proud of the heritage of Xerox, and we mirror the environments that we live in today, and we'll continue that going forward. Obviously, we will be compliant to any of the regulatory or any of the things that come out, but Xerox has always been incredibly diverse. Diversity drives innovation. Mm-hmm. Diversity drives what we do in the communities that we're in. We're proud of what we do. We've always been very successful in that area, and we love our communities that we live in today.
All right, Steve, thanks for coming in. We really
Pleasure.
appreciate it.
Nice
It was wonderful to see you.
Thank you.
Steve Bandrowczak, joining us, CEO of Xerox. 15 minutes to the closing bell. This is The Close on Bloomberg.
There's an enormous amount of capital investment in these companies. There's an enormous amount of demand for their products. There are lots of knock-on effects, including energy utilization. So it'll be interesting to see how they talk about the potential threat that this kind of evolution creates for them. So that's what we'll be looking at more than just the earnings themselves.
Lori Heinel over at State Street Global Advisors kicked us off to the close just about 50 minutes ago. A closer look at earnings, how that ties into valuations, and of course, the big shock that this market got yesterday from DeepSeek and a rethink of that AI trade. A bit of a rebound off of some of those lows from yesterday. NVIDIA, of course, which had an awful day, getting about an 8% jump here on the day, back up to that 127, 128 level. When you look at the totality of the market, though, a NASDAQ composite right now up about 1.9%, a NASDAQ 100 up about 1.5%. This is not a broad-based rally. About half of the members in the NASDAQ 100 still in the red, like a MicroStrategy, like a Texas Instruments, like an Intel, like a PepsiCo. You also see other names, General Motors falling 9% on the day. This after earnings that weren't necessarily bad, but not quite enough to placate investors when it came to the run-up that we had seen in those shares. We should point out we are getting more earnings after the bell tonight, including from Qorvo. Of course, that will be an interesting look. They get about 40% of their revenue from Apple. And of course, there is an AI trade in that as well. Those shares moving lower here on the day by about 2% into the close. And Starbucks, a modest bid heading into the close, as we are expected to get their earnings after the bell. The first full quarter that Brian Niccol has been at the helm of the coffee chain. Saira Malik joins us right now, Chief Investment Officer over at Nuveen, to help us count down to those closing bells. Those bells just about 8 minutes away. And we have to start with the flip-flop, if you will, from yesterday to today. And I know we haven't quite recouped all of the losses from that big AI-driven sell-off, but has sentiment, in your opinion, based on what you're looking at in the price action, actually improved, Saira?
Well, yesterday was an example of shoot first, ask questions later. And the question, of course, being, does DeepSeek cause all of this CapEx that we've made in the U.S. in AI and the return on investment to come into question? I don't think the answer is completely clear yet, but I also think markets were cautious yesterday for two other reasons. We also have the Fed meeting this week, and what will their tone be coming out? And earnings, 40% of the S&P 500 reports this week, led by the Mag 7. So a lot of volatility already, given the news coming out this week. I do think that there's going to be three themes to focus on 2025. First is that the market will broaden in terms of participation of returns, and we're already seeing that with tech taking somewhat of a backseat. Second is earnings. They're going to be very important because market valuations for the S&P are at almost a 20% premium to history. So earnings are going to have to deliver to grow into that valuation. And third, of course, the impact of the new administration. What do taxes, tariffs, and deregulation mean for our economy and the markets?
Talk a little bit more about earnings, Saira, because this is I think, the bugaboo here, right? We've had valuations run up, a lot of it on multiple expansion, a lot of it on the hope that the money these companies were spending would sort of somehow be justified either in revenue growth or in profitability. Do you have high expectations heading into the 40% of the market cap that's about to report?
Well, first of all, fourth quarter earnings overall look good so far, growing about 12% year over year. We're seeing almost 3/4 of companies beat earnings, and that beat is about by 10%. So it's been a good earnings season. Now, going to the Mag 7, I do think we're going to see winners and losers, not only because of DeepSeek, but because of the tremendous growth. We've seen multiples expand for tech stocks over the last 2 years by about 40%. They've about doubled the performance of the broader market over the last decade. So tech definitely has a high hurdle to beat. Stocks that we like are Microsoft and Apple, actually. Microsoft both of these being somewhat of laggard stock. What we like about them is, for Apple, not a ton of that CapEx necessary to benefit from the AI trade. And of course, what's everybody worried about is, have we overspent on AI given what the returns will be? And Microsoft, with that captive audience with Microsoft Office, I think also has that platform in order to grow AI on. So those are two stocks we think could be winners. I think question marks are out there in terms of what does it mean for Google with ChatGPT and also DeepSeek. And Meta, I think, also somewhat unclear as to what their path is from here.
Yeah, Meta getting a bit of a rebound. Kind of interesting to see how Apple had gotten left behind, at least prior to the last couple of days. And of course, their earnings coming out on Thursday, so we'll get a better peek there. I am curious about outside of tech. You do have some interesting stories, particularly with Starbucks, which is scheduled to report, and that's been a laggard for obvious reasons. You have a new CEO, and obviously a CEO that came into this job with a lot of laurels, and a lot of sort of expectations that he can sort of work the same magic there that he did at Chipotle. Do you find value in Starbucks, and more specifically, a Brian Niccol-led Starbucks?
Well, I think there's a lot of optimism around what Niccol can do at Starbucks. It's going to depend on more so than just the earnings print, but what are the quarter-to-date trends in comps? How's that going for Starbucks? Also, can he give clarity in terms of their strategy in China and what they plan to do there? I think those are going to be two very important keys for Starbucks going forward. Not surprised to see it cautious going into the quarter. But like I said, I think the print on this quarter is going to be less important than the outlook and how his new strategic changes are going to accelerate comps from here. Outside of stocks, I think two areas of the market also worth looking at, given all the turmoil in AI. One is infrastructure. This is an area that will benefit from any kind of change in artificial intelligence and that growth. So I think infrastructure is still a nice way to play artificial intelligence and the accelerating demand there. And also take a look at small caps. Small caps have been a laggard for years, even decades at this point. But with the implementation of deregulation, that should be good for M&A, and tax cuts, good for the consumer and corporations. And those highly leveraged, more domestically oriented small caps should benefit.
And do you see stocks at all getting any help from the rate environment? We have a Fed decision on Wednesday, no expectation for rates to change. But as far as what the Fed communicates, is that still a factor for investors?
I think the Fed still is going to be front and center, even though this week it doesn't feel like it with everything else going on. We expect to pause this Wednesday, so we don't think they'll announce any kind of rate cut. Our call for the year is 2 rate cuts as the employment markets continue to moderate and inflation does move towards target. I think the Fed's tone going forward is going to be important. How concerned are they about inflation potentially reaccelerating because of tariffs? And how are they feeling about the economy and the strength there? I think they'll be positive on the economy, a little bit more cautious on their inflation outlook, because we don't know what degree tariffs will come in and what the impact that will be.
One final quick question, only about 30 seconds. That is the impact of Washington policies on the market. You worried?
I think most of the policies are pretty pro-growth. So tax cuts positive for consumer and corporations, deregulation positive for sectors like financials and probably technology. Tariffs are the wild card when it comes to the new administration. I think that could cause a reacceleration in inflation. It could have impact on the employment markets. That's going to be the key one to watch.
Saira, always a pleasure. Saira Malik, Chief Investment Officer over at Nuveen, helping us count you down to those closing bells. Those bells just about 2.5 minutes away, with stocks not far off the session highs. A NASDAQ composite up 2% on the day. A NASDAQ 100 up 1.5%. Of course, a lot of that fueled by the bounce back in NVIDIA. You're also getting some help in the S&P out of Royal Caribbean, having a phenomenal day on the back of its earnings. Boeing, a glimmer of hope there. But keep an eye on what's been going on with the airlines and defense stocks. A big downdraft there. We count you down to the closing bells with the full coverage coming up right now on our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here to take you through the closing bell. A global simulcast starts right now. I'm joined in the TV studio by Bonnie Quinn, Alex Steele, and Scarlett Fu on assignment today. Carol Massar and Tim Stenovic in the radio booth as we welcome our audiences across all of our platforms, including our partnership with YouTube. And if you watched us yesterday, it's a huge turnaround from where we were just 24 hours ago.
It's kind of fascinating, right? So here we have green across the screen. NASDAQ really an outperformer, up 1.5%. But if you look at like the S&P 500, despite being up on the index level, you look into the index and you've got most names in the S&P 500 lower, which is opposite of what we had yesterday. A lot of selling, yet most names were higher. So you make sense of this market trade.
I'm not going to make sense of the trade. What I'm going to do is tell you that even though NVIDIA's up, close to 8% today, still got a long way to go to get back to where it was at the end of the day on Friday. About 13% still from there.
Ben Emmons this morning saying it was a golden buying opportunity. I guess that's true, at least for today, but we don't know what tomorrow is going to bring, right? And I would also point out that this whole reversal didn't extend to the Treasury trade, so that flight to quality that we saw yesterday, that didn't get reversed.
We had a lot of guests on this program, and of course on yours as well, who were basically saying, look, this is an opportunity to buy stocks on sale, high valuation stocks. I guess the question, though, is this going to come back and haunt them?
Yeah, and the earnings throughout the week tomorrow and throughout that AI trade, we're going to get some clarity on that and get some questions answered on that.
And we're expecting some earnings after the bell today out of Qorvo, Packaging Corp, Starbucks, and Chubb, just to name a few, as we get the closing bells in New York. Something to cheer about on the day, with the Dow Jones Industrial Average up more than 100 points, or about 0.3%. The S&P gaining about 0.9% on the day. That's a gain of more than 50 points, right back to that 6,067 level as we wait for these numbers to settle out. The NASDAQ composite looks like it's going to close higher by about 390 points, or 2% on the day. The NASDAQ 100 up more than 300 points as well, or about 1.6% on the day. But I think Carol was kind of getting at when you talk about the overwhelming number of stocks in the S&P were down, and you see that reflected in the Russell 2000, in the S&P 400 mid-caps, and in Dow Transports. The Russell only higher by 0.2%, mid-caps only up 0.1%, Dow Transports lower on the day by 0.9%.
Yeah, exactly. And we do have some earnings crossing the Bloomberg terminal. Let me bring it up for you. Qorvo crossing, and let's get right to the outlook.
Looking good.
Yeah, sees fourth quarter adjusted EPS 90 cents to $1.10 a share, way above the street estimate of 88 cents a share. Go back to the third quarter, adjusted EPS of $1.61. Folks, that is a big beat. $1.22 was what the street was expecting. And you can see investors, pretty happy. Certainly if you're a bull on that name, stock's up 12% in the aftermarket.
The company's president and CEO said, quote, Qorvo is executing on a broad set of strategic initiatives to expand margin, generate strong free cash flow, and increase shareholder value. Saying that, this is Bob Brugaworth, saying that during the December quarter, the company continued to successfully support our largest customer, who represented approximately 50% of sales.
Who is that customer? Apple.
Yes.
Thank you.
Well, listen to this, though. Within our Android 5G product portfolio, they're narrowing their focus to the higher value flagship and premium tiers.
Well, Samsung also a client, but one investor that's really important for Qorvo, of course, Starboard, building a 7.7% stake most recently in Qorvo, according to the Wall Street Journal just a little while back. They'll want to see some results, and obviously Qorvo is really putting everything into this earnings season.
And it kind of makes you wonder what the setup is for Apple, at least according to the Bloomberg terminal. About 46% of the revenue coming from the company. And remember, Apple was a stock that was really taking it on the chin prior to this week because everyone was concerned about a potential slump in iPhone unit sales.
All right, guys, let's get to some of the, as we await more earnings, some of the individual gainers. NVIDIA on that list, a top gainer in the NASDAQ 100, guys, after one day after, seeing that massive rout in its share price and market cap, of course, a record decline by any company in market history. But today, NVIDIA snapping back up almost 9% in today's session. So you saw investors coming back in and doing some buying. Royal Caribbean, also an outperformer, up about 12% at the close, bringing the whole cruise industry higher and among your top gainers in the S&P 500. We did see Royal Caribbean hitting a record today, up the most in more than 2 years. It is the top gainer, as I said, in the S&P. This is after it reported a full-year profit forecast that blew past expectations. Cruise demand continuing to ramp up. We talked with the company's CEO, really outperformance in terms of demand and also excursions, and also now they're moving into river cruises. So they were very, very upbeat about the outlook. They talked about also customers' balance sheets being really good. And so one reason for why demand continues in the cruise industry. CrowdStrike, had to mention, top performer in both the NASDAQ 100 and the S&P 500. Shares, that software area continuing to outperform in the market trade. You had a bunch of analysts talking about B of A, writing that having improved capabilities at lower cost. We're talking about the news that we got yesterday from DeepSeek that essentially potentially, if it's less expensive, that you could see a ramp up in terms of these software companies, their services, and more companies tapping into it when they want to do kind of AI capabilities. So CrowdStrike really an outperformer in today's session.
All right, some of the underperformers. I do want to start with JetBlue. Shares finished the day down 25%. It plummeted the most ever as the company forecast weaker than expected revenue and higher costs for the company for the coming year, 25.7% to the downside. Earlier in the session, it was down as much as 29%. Some of the reasons include rising compensation and aircraft maintenance expenses, grounded planes due to an engine manufacturing defect. We talked to George Ferguson a little earlier in our program, who mentioned that JetBlue kind of lives in this area where not a lot of other companies live. It's not an ultra low-cost carrier like a Spirit or Frontier, and it's not necessarily a premium carrier like the big three. And that makes it difficult in terms of pricing and also difficult in terms of marketing. GM shares falling today, finishing the day lower after the company reported a better than expected profit outlook, with adjusted earnings expected to range from $13.7 billion to $15.7 billion this year. Look at that, shares down more than 8%. The forecast does not account for potential 25% tariffs on Canada and Mexico, which could impact GM's supply chain and profitability. Also important to note that part of the improved outlook, it's largely due to the decision to shutter Cruise, which is the self-driving car unit, expected to save around $500 million this year.
Starbucks results are crossing the wire right now. The company is saying that its North American comp sales were down about 4%. That was the expectation. In fact, the expectation was for a drop of 5%, so better than expected drop for North American comp sales. Total comp sales in the fiscal fourth quarter also down about 4%. The street was looking for 5.3. The company also saying here that when it comes to operating margin, that came in a little bit narrower than what the street was expecting, about 12%. The street was looking for 13%, though on the plus side, average ticket sales, ticket prices, I should say, so basically the amount of money that you spend every time you go there, up 3%. The street was looking for a gain of about 1.9% here. So I guess somewhat of a slightly better start here for Brian Niccol, as this represents that fourth quarter, his first full quarter there at the helm as CEO.
Yeah, and the stock is up about 4% in the aftermarket. Here's some commentary from Brian Niccol, who was, took over last fall. While we're only one quarter into our turnaround, we're moving quickly to act on the Back to Starbucks efforts, and we've seen a positive response. Although we're in the beginning chapter and have much more work ahead of us, we will continue to prioritize shareholder value through dividends, providing a predictable return of capital while we turn around our business. So, yeah, investors, at least so far, guys, like what they see and are hearing from the company. Again, up about 3.9% in the aftermarket.
And that net revenue figure beating as well, Carol, $9.4 billion. The estimate was for $9.31 billion. We'll see if investors give Brian Niccol a little more time. Interesting, too, Tim, to see that China comm sales were much better than the bad number that was anticipated. So analysts were looking for China's comm sales to be down more than 9%. They were, in fact, only down 6%. I'm
wondering how much you can read into these results, given that it has only been one quarter, and a lot of the changes that the company has implemented did not even happen until this week. I mean, we're talking about redesigns to make the stores sort of go back to their roots. The baristas using Sharpies rather than like a printed out receipt. Doing, I think it was 7 lines of caramel on top of those caramel lattes, like but those little details that
but those
supposedly
details
will make a
matter.
difference.
And I remember when he got hired, I mean, he talked a lot about how he spent when he was trying to decide whether to take the job. He was talking about how he just basically went all up and down California where he lives and went into Starbucks and just kind of took note of what he didn't like. And he just said it wasn't an inviting experience, and he wanted to bring that back. And I know some of us who remember kind of Starbucks back in the days, it was a place where you just went and hung out. And now, at least the ones around us here near Bloomberg World Headquarters, it's basically just grab your coffee and get the heck out of there.
Yeah, absolutely. Yeah. But you think about his specialty in terms of how he kind of turned around Chipotle and thought about the dining experience there and those things. So it looks like, at least initially, investors like what he's doing, and we will see. And we'll look forward to what we get on the call a little bit later on. All right, guys, Starbucks, as we saw, up about 3-4% here in the aftermarket. That's a wrap. Our cross-platform coverage of the close, radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. We'll see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television, a deeper dive into those earnings out of Starbucks with Danilo Gargiulo, senior analyst over at Bernstein Institutional Service. Stick with us. This is The Close on Bloomberg.
countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Vonnie Quinn.
And I'm Romaine Bostick. Quite a turnaround from what we saw yesterday. Vonnie, we didn't recoup all of the losses from that DeepSeek AI-related sell-off yesterday, but, well, we got enough out of it. A 1.5% gain on the NASDAQ 100. Similar moves across the board, at least for the S&P and the NASDAQ composite. This was not a broad-based rally. We should point that out. The majority of the stocks in the S&P 500 were actually down, and only half the stocks in the NASDAQ 100 were up. But we should point out that yesterday's sell-off was not a broad-based sell-off either. You did get software stocks get a nice rebound on the day, but some of the sell-off that we saw in the energy and power names yesterday, that did not reverse today. As a sector, the Philadelphia Utility Index down 2% on the day, and we had some relatively, I guess, disappointing news, Vonnie, out of General Motors and the automakers.
Yeah, let's start there, Romaine, because basically this shows you everything you need to know really about today's market action. If you look at General Motors, this was the reaction after earnings actually were quite good. Investors not believing, though, that General Motors has taken into account tariffs that might come on to Mexican goods, Canadian goods, all sorts of other goods. General Motors, how can it possibly project for tariffs, which we haven't even seen yet, and which the Treasury Secretary designate is saying might be 2.5% per month? Trump himself saying it might be 25%. So investors saying, look, we believe you and we like that you're closing the self-driving unit Cruise, but we don't quite believe your forecast. And then you had NVIDIA. So the leaders were back today. It wasn't a broad-based recovery, but it was a recovery for those previous leaders, crawling back up 9% almost. Now, that's only about half of yesterday's decline, and we did have a decline in the previous session as well. Nevertheless, any NVIDIA buyer who bought the dip, as long as we don't see another drop tomorrow, is very happy.
All right, let's get back to some of the after-hours movers, and that includes Starbucks. The shares higher after the company reported, well, a drop in comp sales, but it wasn't quite as bad as what the street was looking for. Brian Niccol, in his first full quarter as CEO, saying that comp sales were down about 4%. The street was looking for 5.3%. Net revenue down less than 1%. Operating income down 24%. But the average ticket, believe it or not, was up about 3%. The street was looking for 1.8. Danilo Gargiulo joins us right now, senior analyst at Bernstein Institutional Services. He has an outperform rating on the shares. And Danilo, when you take a look at the report we got today, I know there are a lot of negative signs in front of those numbers, but were you encouraged by what we have so far out of Brian Niccol in the few short months that he's been there?
First of all, thank you for having us. I would say the results today were relatively expected, meaning we were expecting to see some tough setup into this quarter. We are still in the early stages of what Brian's transformation and back to Starbucks means for consumers and investors. But it's starting to be encouraging. You know, the leakage that we were expecting to see probably didn't materialize to the same extent that most people on the consensus side were also expecting. I think we are onto a kind of the initial recovery signs of the stock. As an anecdote, even going into the Starbucks stores in the past couple of days with a change of code of conduct, I'm actually starting to see already a different environment, a different vibe inside of the store. You're starting to get greeted by the baristas. You can get your ceramic mug, and I had a very pleasant experience myself. Kind of reconnecting once again toward the cup of coffee. And I think these type of experiences were missing for consumers, but it's going to take some time for this to be fully realized by the consumer base. And there is always a little bit of lag before consumers are going to go back at the level of frequency that we will be expecting.
We also have some labor changes. Starbucks hiring Mike Grams as North America Chief Stores Officer. We have Meredith Sandland, who's going to join as Store Development Officer. Is that necessary, Danilo? Will these, add value?
I think splitting Sarah Straling's role into having more focus in store operations and having, even more focus on the development side, given the changes in the layout that Brian is looking to have, is probably the right move. Specifically, I think there needs to be extra responsibility onto the performance of the partners in the stores, and having someone who's, again, fully responsible for the execution of the perfection of the coffee cup that Brian is looking for is a necessary addition to the executive team. So I think these were the right move for Brian. I don't think necessarily that the entire executive team and the transformation from an organizational change are over yet. A lot to come still, given some of the tough decisions that Brian we'll need to make over the next few months regarding the support centers. But I think Brian is starting to get surrounded by people of trust, and it's going to be paramount for the transformation of the company.
Danilo, a sensitive question here, but is Howard Schultz out of the picture? Because there were a lot of people saying that over the last few years with the previous CEO that was there, that maybe, the sort of the shadow of Howard Schultz sort of, interrupted any potential progress that he could have made. Brian Niccol, at least right now, appears to be out of that shadow. Do you have confidence that Schultz will, stay in the corner?
I think so. I think, the part of the reasons why Brian decided to join Starbucks is because he had full mandate to really have essentially opportunity-seeking times at Starbucks that might have been prevented if he was under the shadow of Howard. For as much as everybody appreciated Howard Schultz, obviously having some fresh pair of eyes into regaining the trust of consumers for Starbucks was very, very important. And so I think that right now he's acting without guidance. Obviously, he respects the tradition and the legacy of Howard Schultz, but he's right now looking to find, his own footprint into the company. And so, yes, right now he's acting independently. I think he's going to continue to act independently, especially if Starbucks continues to go into this recovery transition.
Right. Thank you so much for your time today, Danilo Gargiulo, Senior Analyst at Bernstein Institutional Services.
All right, we do want to take a look at another mover in the after-hours trade. That is Chubb, the insurance company, reporting results right now. Net premiums up 4% in the most recent quarter, and operating EPS, at least at its core, $6.02 a share. Bloomberg Intelligence's Matthew Palazola joining us right now to walk us through not just the numbers here, but exactly sort of, where the growth for this company comes from.
Yeah, so what's interesting about Chubb is they are one of the biggest insurance companies in the world, and they have been producing pretty good growth, almost 10% year over year in the past couple of quarters. This may be down a little bit, but you have to look at the ex-currency number, which I haven't seen yet.
So they're also estimating $1.5 billion in a pre-tax cost for the California wildfires in Q1. What will that do going out quarters?
Yeah, so everyone was expecting them to have losses. They insure these high net worth homes in California, so we expected them to have some losses. I'm actually a little surprised that number came out here for the first quarter, but I think given that speculation, they probably want to put it to rest. That is a decent sized number in terms of insured losses, but for Chubb, it's probably very manageable.
Okay, so you don't think that's going to go up materially?
I don't think so from here, no.
All right, Matthew, great stuff. Matthew Palazola over at Bloomberg Intelligence. A quick look at Chubb. Those shares up about 0.2%. When we come back after the break, a conversation, well, you don't really want to hear this. The CEO of a company called Miso Robotics. Have you seen this, Bonnie?
I've seen the flippy.
It is, yes. You got to see this. It's basically, we're going to talk about more automated solutions in the restaurant industry. What you're looking at here is a robotic fry maker. I'm absolutely fascinated by it. It's terrifying, but for companies, the potential to save a lot of money. A conversation with the CEO in just a minute. This is Bloomberg. All right, a lot of stocks moving in the after-hours trade. Qorvo, that's your big gainer, up 18%. But Starbucks getting a pretty decent bid as well, up about 4% on the back of its most recent earnings. The earnings weren't great, but of course, there is a turnaround story potentially afoot there, of course, at the feet of Brian Niccol. And as we focus on Starbucks, we want to focus on the broader restaurant industry, particularly these fast casual chains and, well, how they remain innovative and, more importantly, how they keep costs under control. If you're ever going to go into a Jack in the Box or a White Castle near you, you might actually see something called the Flippy Fry Station. It's made by a company called Miso Robotics. It's an AI-powered robot that automates the preparation of French fries, onion rings, and any other fried item to help streamline food orders. Rich Hole has a very delicious job of being the CEO of Miso Robotics. I'm pleased to say he joins us right now. So, Rich, I'm fascinated by this. Look, I know automation in restaurants isn't necessarily all that new. Companies have been experimenting with this for quite some time. But give us a sense here as to the adoption, the increase in the pace of adoption, and where exactly these restaurants are looking to use automation.
Well, first of all, thank you for having me. And I'm not sure I agree with you on the adoption of automation being so pervasive. Really, the automation space in restaurant kitchens has only been around for about 5 or 6 years. Restaurants have largely operated their commercial kitchens the same way over the last 50 years. There hadn't been a ton of innovation. When we came onto the scene, and we're sort of the first mover in restaurant innovation for the kitchens, we introduced Flippy, which is our fry station robot. He started out flipping burgers, and then he moved over to the fry station, and now he exclusively does that. And so it's really, I think, launched a new era of automation, and it's largely driven these days by labor costs and labor shortages. Labor costs are going up, labor shortages are going up. Restaurants are having a really hard time hiring kitchen workers.
Yeah.
And so now they're finally turning to automation to solve that problem for them.
So give me a sense here of what Flippy costs. I assume my general understanding is the business model is a lot of restaurants would actually rent this more or less rather than buying it outright. Is that cheaper than just hiring me or Bonnie to flip the fries and the burgers?
Yeah, the good news is Flippy never costs more than the equivalent full-time humans, even if you could hire them. And so there's not a lot of risk for the restaurant operators. The list price on a Flippy is $5,400 a month. It's a rental service. There's no money up front. I think there's a misconception in the market that's just a little outdated, that it takes millions of dollars for restaurants to go and add AI-powered robots and AI automation into their kitchen to solve these labor issues. And in fact, it's just the opposite. So you're never going to pay more than you would with the humans. And in fact, Flippy drives a lot of value, both in terms of revenue and cost savings. So you'll actually be making money, all of which drops straight to the bottom line when you put a Flippy into your restaurant and you start to automate these different parts of the commercial kitchen. And especially if you think about what we've done, we've built a Flippy in conjunction not only with restaurant partners, but also with technology partners. So you mentioned NVIDIA earlier. Well, they are our partners. We collaborate with them. They've allowed us early access to their vision AI systems and some of their motion planning systems. And so we get the ability to be the first partner that they choose to roll that out into the restaurant space. And so it really, I think, is a real validation of the fact that AI allows us to do automation in a way that didn't even exist 3 or 4 years ago.
Well, Rich, I understand the automation part, but where does the AI come in? Obviously, Flippy has made, it's almost 4 million baskets of fries now, but why do you need AI for that? Where would you use AI in that?
It's a good question. So Flippy is built around a robotic arm, which is actually one of the more reliable things we have. They've been used for decades in auto factories. But the secret sauce to Flippy is really the AI that powers the arm. Flippy has to make a series of millisecond math decisions about how many fries he's going to put down and when he's going to take them out, because he can't undercook or overcook. He works about twice as fast as a human, but he cooks it 100% perfect every single time. And he gets smarter and smarter as he goes, because every restaurant is different. Not to mention the fact that now Flippy has AI-powered self-healing. So he knows when he's going to get sick. He fixes himself. He's about to launch self-cleaning, which is an AI-powered product. So we've filed about 25 patents on our different AI innovations, which is kind of one of the benefits of being the first mover in this space. And, we also have a lot of support, not only from NVIDIA, but even from our partners at Ecolab, who help us with some of those self-cleaning things. So as you know, Ecolab is a big public company. They're really trying to be more innovative. They are both an investor and a strategic partner in Miso, and they've really helped us figure out how to make cleaning simple for Flippy.
I'm curious as to why the robotic arm. Is there not an easier way to do this, to maybe have the oil drain or something from an AI-powered machine as opposed to having the arm flip? And what's next for Miso Robotics?
Well, if you're applying to be an engineer on our staff, we'd love to have you. It seems like you've got some great ideas. The robotic arm allows Flippy to move really fast, and that's a big challenge for restaurants. When they go and they automate, what they find is that sometimes the innovations that they're adding move slower than humans. And the robot arm, because it's so durable and it's so fast from all of those years in auto factories, it can move really, really fast. And so if you were just having an elevator that raised and lowered the fry baskets, you'd still kind of need a human to sit there, grab it, put it in, take it out. And Flippy does all that work for you. So he's kind of one-stop shopping, and he allows the humans to go focus on other things in the kitchen because they have a lot of stuff to multitask on.
And all for just $5,400 a month. Rich, thank you so much. Fascinating to watch. That is Rich Hull, Miso Robotics. Coming up, Dave Layton, CEO at Partners Group, is going to join us with his outlook for the private equity market this year. This is The Close on Bloomberg. Private equity asset managers are looking to 2025 to be a year of growth, whether that's driven by a stronger fundraising environment or the highly anticipated influx in deal making. Joining us now for more on what to expect from PE is Bloomberg News' private equity reporter, Allison McNeely. So, Allison, what are the key themes we should be focused on for private equity this year?
So I think everyone is trying to will better days ahead. Private equity has had a kind of tough couple of years, really since the Federal Reserve started hiking interest rates. We've seen fewer asset sales, so less cash going back to investors. We've seen a more challenging fundraising environment, and we've seen a lot of economic uncertainty, really around sort of growth, inflation, that sort of thing. And so what we're really watching for this year is to see if folks kind of get off the sidelines a little bit, start selling more investments, returning capital to investors, and whether or not that's going to make fundraising a little bit easier, if we're going to see more IPOs pick up, and generally a more active environment.
There's also been, of course, a shift in Washington, at least in spirit. I mean, it's going to take some time to see those policies, but there's a lot of folks, a lot of investors out there who seem to be encouraged by this idea that I guess maybe the leash won't be as tight as it was the previous 4 years when it comes to Washington regulation.
Absolutely. So there's definitely a sense that there's going to be a more friendly environment for deal making, maybe less antitrust scrutiny, sort of more regulatory scrutiny in general. And with regards to private equity, one thing we're also really interested in is whether or not we're going to see more advancements in 401ks. Yes. Private equity is trying to place products with retail investors, individual investors, and there's a sense sort of brewing in the industry that there might be a friendlier environment in Washington for some of those efforts.
It will be fascinating to watch that. Also, continuation funds and the appetite for those, but also real estate funds. So what's going to happen there in 2025 with Trump in office and at the same time the Federal Reserve on the back burner?
Exactly. I think people, depending on who you ask, we might have hit the bottom of the real estate market. We might be hitting the bottom right now. I think similarly, we've seen commercial real estate come under a lot of pressure in the last couple of years because of higher interest rates. And I think folks are keen to see maybe a better market conditions for that, sort of an opportunity to kind of deploy capital into that bottom and make some more investments.
All right, Allison McNeely helps lead our private equity coverage here at Bloomberg. Let's get some perspective from somebody who, well, is on the grounds, on the front lines. Dave Layton joins us right now. He's the CEO at Partners Group, which has invested more than $234 billion in private markets since its inception. Is that number going to go up this year?
I think that number will go up this year. We saw about a 17% uptick in activity in equity deployment 2023 to 2024. Now, that recovery is not being shared proportionally across market participants. Partners Group was up 65% in terms of its activity levels. And we invested $22 billion last year. And we've got a pretty good pipeline headed into this next year.
We talk a lot about this idea of dry powder or cash on the sidelines. Is that real?
It's real. The way you need to think about dry powder is how much time is it going to take for that dry powder to get worked through? And if you look at expectations for pickup in activity, we have reason to believe that we'll be able to work through that inventory of capital in about 3 years' time, assuming a reasonable pickup in activity levels. And that starts to get back to more reasonable time frames versus a couple of years ago. You know, it looked like 5 years, 6 years of deployment with activity levels at those that reduced levels. And so at 3 years, that's about the average time it takes your average fund to deploy their capital. It starts to feel more reasonable.
What happens when public markets are as volatile as they have been for the last few sessions? Does it impact private markets at all?
Yeah, it sure does. One of the things that institutional investors have found over this last 20 or 30 years is that if you're only in the public markets, you're increasingly exposed to the volatility that comes from the technology sector, right? Institutional investors have expanded their allocation into private companies to now be, 20, 30% of their portfolios in many cases. And they have the benefits of getting exposure to a much broader swath of the economy, because many of the companies that are held in our portfolio and in the portfolio of other companies like us are not accessible to everyday investors today. But institutional investors have the benefit of having that stability within their portfolio. And you're starting to see individual investors trying to get into the asset class more and more.
Now, it does sound like you're doing everything really, really well. You're bringing in more money. You're investing in above average companies, of course. But I'm just wondering, are there, easy to find above average companies anymore? Where are you looking for them? What sectors?
Absolutely. So the private markets have become home to the winning mid-cap companies. Okay, companies that would have been public companies in a prior era, right? And it would have been, the growth, next generation growth companies and middle market that investors get exposure to, and those have been increasingly staying private. So we found a number of very interesting private companies this last year. Again, invested $22 billion of our clients' capital into primarily middle market companies. And
what sectors though? Like where are you finding those opportunities to be the richest right now?
Yeah. So in the automation space, for example, we've made a big investment into the industrial belting sector, right? Where automation equipment is on the rise, and there's a consumable element to that equipment, right? Moving packages, moving product, moving food along manufacturing facilities. So we made a big investment and have continued to invest into a big industrial belting platform, for example. Great middle market company. Industrial services, for example, has been a big space for us. We acquired a Swiss middle market $2 billion enterprise that inspects critical infrastructure. Again, that's a business we would have had to pay 15, 16 times for a couple of years ago. But because of the reduction in competition that we've seen over the last couple of years, we were able to buy that business for 13 times.
It's interesting you say that. We were speaking with a big real estate investor earlier in the show, and he was kind of giddy at this idea that he's able to buy, make investments, buy properties at prices that he wouldn't have never been able to get years past. I do wonder about the environment right now and how you value a potential deal and whether it truly is offering you value. There is a true value gap there.
Well, that value gap can be manifest when we take our portfolio companies public, right? And you can see the difference between the marks in our portfolio and the marks that you get externally, either through a strategic sale or through an IPO.
And you think that's going to be smoother this year than what it was in the last couple of years?
As I look at our last 4 big exits, we saw a 40% uplift on a capital-weighted basis between the IPO price that we were able to achieve or the transaction price that we were able to achieve and the marks that we had in our books just 6 months prior. So I do think that there is reason to believe that there is a value gap that does exist there.
Have to get your perspective on the ex-debt being shopped, even if you're not involved. Surely clients are calling up and asking you, is there anything about this that's interesting? Particularly given that we're reporting the sweetener, that there might be some claim on XAI at something like a $50 billion valuation for the people who do buy some of this debt.
Yeah, I don't have much of a perspective on that. That's not really the world that we play in. But I do want to come back to one thing that you mentioned just a minute ago, which is the individual investors that are coming into this space. And we are starting to see that much more. Individual investors that want exposure. We raised $8.4 billion into our evergreen solutions this past year. And we've been in that business for 20 years. That's the biggest year that we've had in a long period of time.
This is a wealth management project, more or less. And I'm curious, because, it's interesting you say that, because I can't remember if you or Bonnie was saying something about this earlier, or maybe it was Allison, about, for people maybe potentially getting access to this through 401ks. And I was looking at this. I had a conversation a few weeks ago with an investor who was talking about this idea that all of the real investment opportunities, not all, but a good chunk of them, aren't in public markets. You're just not going to get them right now. Maybe that changes if the IPO market comes out. But a lot of the more tantalizing things are in private markets. And at least for years, that was basically walled off to, the average individual investor. You're saying now that door is open.
That door is open. And we're starting to see allocations open up more and more from individual investors. Now, they need products that work for them. We formed a joint venture with BlackRock, for example, to give an individual investor the ability to invest into a comprehensive portfolio solution balanced across equity and credit and real estate and infrastructure, for example, and with a single subscription document, a single login per se, an individual investor can now get a professionally built, professionally balanced portfolio built the way that an endowment would do it or the way that an institution would do it. So those type of solutions are coming to individual investors, and I think it's an exciting phenomenon.
All right, Dave, great stuff. By the way, you didn't invest in that Flippy Fry robot thing.
I didn't invest. I missed that one.
Okay.
I missed that one.
Because that's pretty cool, by the way. All right, Dave, guy, of course, he's got some much better investments than that. Dave Layton is the CEO over at Partners Group. Bonnie.
All right, Romain, let's take a look at how markets closed on the day with the S&P 500 up 0.9%. Who would have thunk it, as they say? The Nasdaq 100 up 1.6%. Now, the Dow was up just 0.3%. What does this remind you of? Well, it reminds you of the market moves of the last year, basically, or more, right? And then we had plenty of after-hours movers as well, didn't we, Romain?
Yeah, Corvo, obviously one of the big ones here. They get about 46% of their revenue from Apple. And take a look at those shares there. That's the second line of your screen, up about 12% on the back of their earnings. Don't forget, Apple reports earnings on Thursday. A modest bid coming into Starbucks. And Skyworks also getting the lift off of the back of Corvo. Skyworks, another Apple supplier. Stick with us. A lot more coverage coming up here on The Close, including a conversation with AI pioneer Andrew Ng. This is Bloomberg. The DeepSeek saga has really called into question the true value of U.S.-based artificial intelligence tools. These past 5 years, venture capitalists have committed at least $300 billion in investment right here in U.S. AI, making yesterday's tech rout all the more prominent. But some say that a formidable and cheaper rival, like what DeepSeek put out there, could serve as motivation for U.S. tech companies rather than competition. So let's get some insights out of a pioneer in this space. Andrew Ng joins us right now. He's the founding lead of the Google Brain team back in the day. He worked at Baidu as chief scientist and now is managing general partner of the AI fund, a venture studio that helps entrepreneurs build AI companies. And Andrew, I want to start off first with what DeepSeek really is, because I've heard some people talk about kind of the difference between kind of that layer on top that I think most consumers are familiar with when it comes to using chatbots and et cetera, and then kind of that stack that goes underneath it, which is a lot more complicated, at least to someone like me, and requires a lot more ingenuity and power. What exactly do they have?
Well, that's a great question. So this is what I think of as the AI stack and where investors and businesses may invest. At the lowest level is the semiconductor layer. So companies like NVIDIA, AMD. Then we have cloud companies using semiconductors to provide cloud services. Then on top of that are the large AI model trainers. Companies like OpenAI, Anthropic, and also DeepSeek have trained these very large AI models. And then on top of that is the application layers where people can build customer service chatbots or chatbots you can talk to on the web, and that's the application layer. So DeepSeek announced a real breakthrough in the large AI model layer, also called the foundation model layer. And I think that's what took quite a few people by surprise and caused some turmoil in the market in the last couple of days.
I understand why investors would be rattled by that, of course, because a lot of them piled into some of these companies on the expectation that you needed to spend tens, if not hundreds of billions of dollars to do this. But at some point, we knew technology, as it typically does, ends up finding a way to bring those costs down. Are we there? Is this kind of that inflection point where the cost to build these things is going to start to come down materially?
I think that DeepSeek showed with technical innovation, driven partly by the U.S. embargo on semiconductors, it is possible to train models cheaper than was widely appreciated. I should say, though, in addition to all this competition at the technology layers, the semiconductor, the cloud, the AI foundation model layers, I think what we saw with these costs coming down is actually good news for the vast majority of businesses, because it turns out that most of the money will be made in the application layer, because for this AI stack to work out, the applications have better generate even more revenue to be able to pay for the technology layers. So DeepSeek's announcement of being able to train a model for, on the order of $5-6 million with some asterisks around it, as opposed to hundreds of millions of dollars, that was seems like a real technical breakthrough, but it's actually good news for all the people wanting to build applications on top of these technology layers.
So, Andrew, if you were advising large companies that need to use some of these services, would you say, yeah, use DeepSeek? I mean, we saw some massive moves today for tiny companies that just said they were going to use DeepSeek. I'm talking about Microcloud Hologram and some of these, very small companies. But would you advise the larger companies to not bother building their own?
I think the training AI foundation models is capital intensive, very competitive, is a very tough space to enter. As the companies build on top, I think there are geopolitical considerations and safety considerations, but I tend to encourage companies at the application layer, which is where most of the money will be made, to use a variety of models and don't get locked into a single model, but just embrace that with multiple tools out in the world, many of them very cheap. So let's try a bunch of them and see what works for you and preserve that flexibility to switch models in the future.
Sure, but if you're a public company and you're announcing your CapEx spend and it's $65 billion one day and then the next day it could be potentially half that, then you've got a problem with investors unless you decide what you're going to do. So you can't just sort of throw everything at the wall, right?
It turns out that those massive billions of dollars CapEx spends are often for the AI model builders. Because others have spent so much money training AI models, it turns out to be very capital efficient now to build applications. So people have been wrestling with, boy, there's this massive CapEx, where's the ROI? The good news is, if you're working the application layer, you can now access these very expensive models, expensive to train for, dollars or cents, and build very high ROI applications on top of these models. So really more business, even though the hype and the buzz tends to be on the technology layers and large AI models, I think more businesses should focus on building applications, taking advantage of this great technology.
Is that how, I guess, the U.S. stays competitive in this? I know there's been a lot of talk about the government's role in facilitating or maybe standing in the way of some of this development. And I know there's been so much focus, certainly in public markets, on NVIDIA and their chips and the export controls on that. But do you see, I guess, a broader world of AI development that goes beyond that and that can work in a cross-border type of way?
So I think the previous era of export controls have largely failed and even incentivized China to work harder to optimize these workloads. And there's actually one other important geopolitical trend, which is I think DeepSeek crystallized the fact that China's been catching up to the US in generative AI for a long time. China, frankly, has been releasing open source, open weight models for quite some time now, but most people were not broadly aware of that. And I think this has implications as well on the supply chain of AI and on the two nations, US and China's soft power and maybe even hard power. Open source is one of the most precious things in AI, where people publish models on the internet free for anyone to use. And it turns out that the US has been going through a lot of thinking of, should we even do this? Should we slow down AI process? I think slowing down AI progress is one of the dumbest ideas ever. But it turns out that if the US doesn't step up its game, then I think China will dominate the supply chain for open source models. And these models will reflect probably more China's values rather than American values. And so, when it comes to winning a race, I think there are two theories. One is you can run harder and faster. The other is you can try to trip up the other guy. I think the US should try to run faster and harder.
Yeah, well, there's a lot of tripping up going on the U.S. side. And I do think it's interesting that the founder of DeepSeek chose to take the open source model of this. So it's all for us to see right now. And I am curious, maybe if you can draw on your experience. I mean, you obviously did time at Google Cloud, and of course you spent some time running the AI team over at Baidu. Is there a fundamentally different approach to what Chinese companies, and for that matter, the government, are facilitating versus what U.S. companies and the U.S. government are facilitating?
I think they are very different. Under the previous White House administration, I think many of us constantly wish that the White House would do more to support tech, and even, or if not support tech, then at least slow down the rate at which they're throwing up roadblocks to progress in American tech. Frankly, I think China was behind the US a couple of years ago in generative AI, but China has played its hand well and has advanced significantly, whereas the US was having these sort of angst conversations about, slowing down the technology, which is really not a smart idea, rather than figuring out how to accelerate the tech development.
So that's all about how we should think about the technology, Andrew, right? But what if you're an investor looking to potentially, profit from this, or at least not lose, pots of money? We had Ray Dalio in the FT saying that this is similar to the US stock bubble that we saw before the dot-com bust. Ray Dalio also has big ties with China. How are we meant to think about AI as an investor?
I would separate out investment in the large AI models called the foundation models versus investments in building valuable applications. And by applications, I mean things like customer service chatbots or AI doctors and AI lawyers to help with paperwork or medical diagnoses and all of the wonderful applications you can build on top of AI foundation models. I think the business of training AI foundation models is tough. It needs massive capex to train large models, and now maybe DeepSeek showed you can do it much more cheaply. And then also because of newer versions of Moore's law, semiconductors are just getting faster. And so what costs you $100 million to train this year, maybe someone else could do for $20 million. So maybe that'll work out for some businesses, but training AI models, that is a tough business, but I hope it works out for many of the leaders. But what is very clear is the ROI of building applications to help you file paperwork for cross-border trade or to route emails within an enterprise or to do SDR work. That's very valuable. So that's a great layer to be building on. Although I think to ensure American competitiveness, we should work at all layers of the stack.
Yeah, I think some people forget that. A lot of benefits to this beyond just, of course, what investors make off of it, and sometimes that'll take care of itself. Andrew, we really appreciate you taking time for us. Professor Andrew Ng there is a managing general partner over at the AI Fund, the founder of Deep Learning AI, co-founder of Coursera, and the author of hundreds of papers on machine learning, AI, and tech. When we come back, we're going to set you up for some of the potential market-moving events over the next 24 hours. This is Bloomberg. Another busy day here on Tuesday in U.S. financial markets. Wednesday promises to be busy as well. We get Bank of Canada rate decision out in the morning, Bonnie. And then down in Washington, we're going to get Senate confirmation hearings for RFK Jr.
And Howard Lutnick as well. And then, of course, 2 p.m., it's the Fed decision. Not like we're expecting any kind of rate decision, but there might be just some language in there that might roil markets a little bit. You never know.
Everyone wants to hear what Jay Powell actually has to say about the potential path going forward. That could move markets, maybe not. What will move markets, though, are some big earnings out of big tech.
Meta up 16% in January, Microsoft up 6%. It could be a battle between both on AI spending.
Tesla, IBM, Lam Research also scheduled to report, as is ServiceNow, Wolfspeed, ASML, the big European chip maker, that's coming out later tonight. We'll be back tomorrow.